For centuries, gold served as humanity's preferred store of value, portable, scarce, and impossible to counterfeit at scale. Today, a subset of institutional investors argue that Bitcoin represents a digitally superior alternative, finite, divisible to 8 decimal places, transferable globally without intermediaries, and secured by the most powerful computing network ever assembled. The core thesis rests on one immutable fact: there will only ever be 21 million Bitcoin. This is not a policy decision. It is code enforced by thousands of independent nodes around the world. No central bank governor, no treasury secretary, no sovereign legislature can alter this cap. In an era of unprecedented monetary expansion, that constraint has profound implications for any institution managing long-duration liabilities or seeking inflation-resistant reserves. Yet the store of value thesis is not without legitimate challenges. Bitcoin's volatility remains orders of magnitude higher than gold's. Its 12-year track record pales against gold's 5,000 years of monetary history. And the regulatory environment continues to evolve in ways that create genuine fiduciary risk. In this analysis, we examine the thesis rigorously, as any investment committee should, weighing the evidence for and against Bitcoin as a legitimate reserve asset. When comparing Bitcoin and gold through an institutional lens, the analysis reveals a complex picture. Gold benefits from 5 millennia of monetary trust, a 3.5 trillion market cap that absorbs institutional flows without distortion, and a custodial infrastructure that every major prime broker and sovereign vault operator understands intimately. Bitcoin, by contrast, offers properties that gold cannot match: instant global settlement without intermediaries, perfectly verifiable supply at any moment, and a supply growth rate that will approach zero over the next century. After the most recent halving, Bitcoin's annual issuance rate fell below 1%, making it harder by the year than gold itself. The critical question for investment committees is not which asset is theoretically superior. It is which asset fits within existing risk frameworks, custody capabilities, and regulatory constraints. Most institutions begin with a 1 to 3% allocation precisely because the volatility differential is real and must be sized accordingly. Bitcoin's supply schedule is perhaps its most elegant design feature. Every 210,000 blocks, approximately every 4 years, the reward paid to miners for securing the network is cut in half. This programmatic halving continues until all 21 million Bitcoin have been issued, projected around the year 2140. This is not analogous to a central bank raising interest rates or a mining company reporting lower or grades. It is a deterministic, pre-scheduled reduction in new supply that every market participant can calculate in advance. The contrast with fiat monetary systems, where supply decisions are made by committees of economists in response to political pressures, could not be more stark. For institutional investors modeling long-duration scenarios, the halving schedule means that Bitcoin's stock-to-flow ratio, the ratio of existing supply to annual production, roughly doubles every 4 years. By the 2030s, Bitcoin's stock-to-flow will exceed that of gold, a metric that some analysts argue is the strongest fundamental case for the digital gold thesis. The institutional adoption of Bitcoin as a treasury asset has moved from theoretical to operational. MicroStrategy, now rebranded as Strategy, pioneered the corporate treasury model, accumulating over 500,000 Bitcoin and demonstrating that a publicly traded company could use BTC as a primary treasury reserve without triggering catastrophic shareholder revolt. The more significant development, however, is the launch of spot Bitcoin ETFs in the United States. BlackRock's iShares Bitcoin Trust crossed $0 billion in assets under management faster than any ETF in history, drawing inflows from registered investment advisors, family offices, and pension plans that previously lacked a compliant vehicle for Bitcoin exposure. This infrastructure build-out is not trivial. It represents the plumbing through which trillions in traditional capital can flow into the asset class over the coming decade. Austrian economic theory defines money by 4 properties: scarcity, durability, portability, and verifiability. Gold, for all its virtues, has always struggled with portability at scale. Moving $1 billion of gold between jurisdictions requires armed convoys, specialized vaults, and weeks of logistics. It is why the gold standard ultimately collapsed. The physical asset could not keep pace with the velocity of modern commerce. Bitcoin satisfies all 4 criteria simultaneously. It is scarce by mathematical law. It is durable. A private key on cold storage can survive for centuries. It is portable. $1 billion of Bitcoin can be transmitted across the globe in 10 minutes for a trivial fee. And it is verifiable. Any node on the network can audit the entire supply and ownership record in real time, without trusting any third party. This analytical framework is increasingly the language used by institutional investors when they present Bitcoin to their investment committees. It moves the conversation from speculation to fundamental analysis, which is exactly where institutional allocators are most comfortable operating. No credible institutional analysis of Bitcoin concludes without a serious treatment of risks. The volatility profile alone disqualifies Bitcoin from many fixed income-oriented mandates. An 80% drawdown, while temporary in retrospect, can trigger redemption pressures, margin calls, or regulatory scrutiny that forces institutional liquidation at precisely the wrong moment. Regulatory risk is not theoretical. Multiple jurisdictions have restricted or prohibited Bitcoin ownership for financial institutions. While the trajectory in the United States, European Union, and several Asian markets appears favorable, the regulatory environment remains in flux. Any institution building a Bitcoin position must model scenarios where the regulatory landscape shifts adversarially. Custodial risk is perhaps the most tractable of these risks, but it requires genuine infrastructure investment. Self-custody via multi-signature cold storage or third-party custody with qualified custodians like Coinbase Custody, BitGo, or Anchorage Digital must be evaluated against the institution's operational capabilities. The FTX collapse was not a Bitcoin failure. It was a counterparty failure, the same risk that exists with any prime broker. The store of value thesis for Bitcoin is neither proven nor disproven. It is a live experiment running on the most adversarial network in financial history. Every day that Bitcoin operates without a supply violation, a successful 51% attack, or a fatal protocol flaw adds another data point to its credibility as a store of value. For institutional investors, the actionable conclusion is this: the question is no longer whether Bitcoin deserves consideration. It is how to size and structure the exposure responsibly. The spot ETF infrastructure, the emergence of qualified custodians, and the growing track record of corporate treasury adoption have collectively lowered the fiduciary barrier to entry. The investment committee that ignores Bitcoin entirely is making an active decision to forego optionality on the possibility that a new monetary paradigm is emerging. The investment committee that allocates without rigorous risk management is making an equally serious error. The path forward is analytical, sized appropriately, and grounded in the four pillars of any credible store of value: scarcity, durability, portability, and verifiability.